Imagine you're making smart moves in crypto, thinking you're doing everything right, but then the IRS hits you with a surprise tax bill. This is a very real risk, especially with the rise of Bitcoin ETFs. While these new investment vehicles offer incredible convenience, they also introduce a major tax trap that could cost you thousands if you're not careful. In this video, we'll dive into the critical differences between holding direct crypto and ETFs, explain the notorious wash sale rule, and show you exactly how to navigate the 2026 tax landscape to avoid costly mistakes. Don't let a simple oversight turn your crypto gains into a tax nightmare. The world of digital assets got a huge shakeup on April 8, 2026, with the launch of the Morgan Stanley Bitcoin Trust, ticker MSBT1. This wasn't just another ETF. Morgan Stanley became the very first major U.S. bank to issue its own spot Bitcoin ETF2. That's a massive vote of confidence from traditional finance. This new entry joins a booming market of over 10 spot Bitcoin ETFs that collectively manage more than $85 billion in assets as of April 2026. 3. What makes MSBT particularly interesting is its aggressive fee structure. It launched with an expense ratio of just 0.14%, or 14 basis points forward, making it the most affordable option in its category. This is designed to attract long-term investors and clients from Morgan Stanley's vast wealth management network. While this means easier access to Bitcoin exposure within traditional brokerage accounts, it comes with a critical catch. The tax rules are fundamentally different from holding crypto directly. The biggest tax distinction here comes down to how the IRS classifies these assets. A Bitcoin ETF is treated as a security, just like a stock. But direct Bitcoin holdings, those are considered property. This single difference creates a whole cascade of tax implications you absolutely need to understand. When you sell shares of a Bitcoin ETF, your brokerage firm will track that transaction and issue a Form 1090, which simplifies your tax reporting. Your gains are then categorized as either short-term or long-term. If you hold those ETF shares for 1 year or less, any profit is taxed at your ordinary income tax rate. For the 2025 tax year, these rates range from 10% to 37%, depending on your income bracket. 5. But if you hold the shares for more than 1 year, you get to benefit from lower long-term capital gains rates. For 2025, these are 0%, 15%, or 20%, again, depending on your total taxable income. 6. This is a crucial distinction from direct crypto, where the reporting can be much more complex. Now, here's where most people get it wrong, and it's a critical tax trap. For years, savvy crypto traders have used tax loss harvesting to manage their tax bills. This meant selling a cryptocurrency at a loss to offset capital gains, and then immediately repurchasing it to maintain their position. Because the IRS treats direct crypto as property, this strategy has been perfectly valid. However, this strategy absolutely does not work for Bitcoin ETFs. According to Internal Revenue Code Section 1091, the wash sale rule disallows a loss deduction on the sale of a security if you acquire a substantially identical security within 30 days before or after the sale. 7. Since Bitcoin ETFs are securities, they fall squarely under this rule. This means you can't just sell an ETF for a loss and immediately buy it back to harvest that tax benefit. This rule is a major departure from how many crypto investors are used to operating. Let's walk through a quick example to make this clear. Imagine you buy 50 shares of a Bitcoin ETF for $10,000. Later, the market dips, and you sell all 50 shares for $8,000, realizing a $2,000 capital loss. 2 weeks later, feeling optimistic about Bitcoin's recovery, you buy 50 shares of the exact same ETF. Here's the result. The wash sale rule is triggered. Your $2,000 loss is disallowed for the current tax year. It doesn't disappear entirely, but it's added to the cost basis of your new purchase. This defers the tax benefit of that loss until you eventually sell your new position. This creates a huge tax trap for investors who are used to the flexibility of direct crypto trading. It also sparks questions about what the IRS considers substantially identical. While selling and rebuying the same ETF is a clear wash sale, The guidance is less clear on selling one Bitcoin ETF, like BlackRock's IBIT, and buying another, like Morgan Stanley's MSBT, until the IRS provides specific guidance. The safest approach is to assume different spot Bitcoin ETFs could be deemed substantially identical. The spot Bitcoin ETF market has been a roller coaster of dramatic inflows and outflows. You see hundreds of millions pouring into funds one day, and then significant net outflows the next. These institutional movements create price volatility, which has direct consequences for your tax strategy. First, volatility means more taxable events. Frequent trading, even if it's profitable, means you're constantly locking in tax liabilities. Without meticulous tracking, it's easy to lose sight of your potential tax bill. On the flip side, volatility also creates opportunities for tax loss harvesting. If you have a losing position in a Bitcoin ETF, you can sell it to offset gains from other investments, like stocks or other ETFs. But remember, you absolutely must be mindful of the wash sale rule and wait at least 31 days to repurchase a similar asset. This leads to the short-term versus long-term dilemma. Market swings can tempt investors into short-term trading. While potentially profitable, this strategy is tax inefficient, as gains are taxed at much higher ordinary income rates. A disciplined, long-term holding strategy, meaning more than 1 year, remains the most tax-advantaged approach for capital appreciation. Tracking frequent trades across multiple brokerage accounts can quickly become overwhelming, especially when you're trying to navigate complex rules like the wash sale rule. This is where a robust crypto tax tool becomes essential. dTax, for example, can automatically import transactions from your brokerage accounts, calculate your gains and losses while accounting for holding periods, and ensure you don't miss a single taxable event. It even supports 22 blockchains and 13 different cost basis methods, so you can optimize for the best outcome. The pre-audit sandbox feature can scan your transactions against IRS audit risk categories before you file, giving you peace of mind. Check out .com. It's open source and free to start, helping you manage your crypto taxes with confidence. For now, the tax reporting for Bitcoin ETFs is relatively straightforward. Your brokerage firm will send you a Form 1099-B at the end of the tax year, detailing your gross proceeds and, in most cases, your cost basis. 8 will then use this information to complete Form 8949 and Schedule D of your tax return. However, the reporting landscape for direct crypto holdings is about to change significantly. The Infrastructure Investment and Jobs Act of 2021 introduced new reporting requirements that will eventually lead to a new Form 1090-A for direct crypto brokers. While ETFs will continue to use the Form 1090-B, this new reporting for direct crypto means greater scrutiny across the board. It's more important than ever to keep meticulous records for all your crypto activities, whether it's through an ETF or direct holdings, to ensure you're ready for any future IRS changes. Let's tackle a couple of common questions. First, can I use a Bitcoin ETF to tax loss harvest against direct crypto gains? The answer is generally yes, but with a big caveat. You can sell your losing ETF shares to offset gains from your direct crypto, but you must still abide by the wash sale rule for the ETF, meaning you cannot repurchase a substantially identical ETF within 30 days. Second, what if I sell one Bitcoin ETF for a loss and immediately buy a different Bitcoin ETF? This is a gray area. Until the IRS issues specific guidance, it's safest to assume they could be considered substantially identical, triggering the wash sale rule. Always err on the side of caution or consult a tax professional. Finally, what happens if I ignore the wash sale rule? If the IRS catches it, your loss deduction will be disallowed, potentially leading to underpaid taxes, penalties, and interest. It's not worth the risk. The introduction of Bitcoin ETFs like MSBT is a game changer for crypto adoption, but it's crucial to understand these new tax rules. The wash sale rule is a significant difference from direct crypto holdings, and ignoring it can lead to painful tax surprises. Stay informed, keep meticulous records, and use the right tools to ensure you're compliant. Thanks for watching, and I'll see you in the next one.